Thank you, Marcus. Can everyone hear me in back there? Okay. Well, thank you. It's good to be here. I haven't given this speech ever, so hope you bear with me today. I find myself probably in a more thoughtful mood. There's been so much to think about recently with the gold price and financial markets that I think my speech today will be less about investment markets and more about kind of the world we're headed to. But what I'd like to cover is where we are financially, this transition phase that I think we're coming up against because of dollar devaluation, and what it means for the rest of us. So I'm a little out of sorts because I just gave a short interview on I think it was Sky News, and you sit in front of a camera and you can't see who you're talking to, and they ask you a question: is the gold standard good or bad? Go. And you sit there and think, geez, how do I answer that one? So I'm glad to have a little bit more time. I'm going to come down here just because I'm a little more comfortable. That's better. I changed Marcus's title because I realized when we discussed originally what we needed to cover in this, that the welfare state is really just one aspect of the financial system that's grown up around the fiat money system. The other aspect of it is the warfare state, which is Americans' favorite because we benefit from that. So I want to talk about both of them because I think the changes to both of them will be profound in the next few years. So that's why I've changed the title to the woeful state that we're in. And what I mean by that is we have reached the end of a significant period of monetary history. And it's not just a financial event, it's a sociological event. The way our lives are organized, the way credit is made available to people. The world that we live in is a product of a fiat money system that makes credit available to the state and to households and to businesses. And if that world is fundamentally changing, which I think is my contention that it is, and probably not the only one, if that world's changing, it's going to be profound. It's not going to just be a trade. So we should think about it. And I think today, anyway, what I want to do is just share with you what I've been thinking. I haven't reached a lot of conclusions. I think some of them are inevitable. But this transition from the dollar standard to what goes beyond the dollar standard, I think, is a very interesting, tricky, and dangerous question. It can also be profitable, but it requires quite a bit of thought. So if this is less than a straightforward argument, I hope you'll forgive me for that, because I'm trying to share with you what I'm thinking about right now. But let's talk about where we are today just financially, because so much has happened in the last week with the Federal Reserve deciding to print $600 billion and basically let everybody know that it's no longer responsible for the value of the U.S. dollar. I think that's what's happened, is the Fed has told the rest of the world, the dollar is your problem. Our main mandate right now isn't price stability like they've said. Their main mandate is making sure there are no more U.S. bank failures. I didn't hear all of the other gentlemen's presentation, but this is one of those questions. It doesn't get a lot of scrutiny in the press, and it might be a surprise to a lot of people. But the Fed is owned by the U.S. banks and does the bidding of the U.S. banks. And if the U.S. banks are stuffed with housing-related assets and government debt, and they're worried about the new Basel requirements for capital, the Fed is going to do everything it can to improve the bank's ability to survive what's coming. So I think you've got to look at everything the Fed is doing. It doesn't have anything to do with improving U.S. export competitiveness, because what does the United States make that it's going to export more of when it's cheaper? It makes aircraft, it makes military stuff, and we export the dollar. But anyway, I think that's what we've got to think about when we're looking at the Fed. Interestingly enough, I'll show you some charts. Commodities have called the Fed's bluff on this, and it took a day or two to see what was going to happen. But there's probably an interesting question about whether or not commodity prices are behaving now as they were in 2008. In other words, how much of their price behavior can be explained through speculation in the futures markets or just investment demand, and how much of it is a genuine reply from the world's investors that they're now concerned about the stability of the dollar. I think it's the latter, but I think there's a little bit of both going on. The gentleman on the TV asked me, he said, you say that the Fed has told everyone, in effect, that it's going to devalue the dollar, but your Treasury Secretary went on television last week, and he told everyone that it was the official policy of the United States to have a strong dollar. And I said, well, Tim Geithner is not an elected politician, but I suppose with Treasury secretaries, the same saying applies. When they move their lips, they're generally lying. And it's a dangerous thing historically. Any time a Treasury secretary of any country or a finance minister is forced into a position publicly to say that he's not going to devalue the currency, almost invariably something catastrophic happens soon thereafter. So if you're a contrarian, I would be concerned about that. So really, my point is the U.S. has abandoned its role as the steward of the reserve currency. Now, this is probably debatable because there are tremendous benefits associated with owning the world's reserve currency. The main benefit is that you don't have to pay back debt to anybody else in anyone else's currency. You can just pay back your debts in your own currency. So why would you surrender that advantage? I think that's a genuine question, and honestly, I don't know the answer. My answer is that the Fed is really thinking in a very small box right now, and it's really only acting to preserve the welfare of the U.S. banks, and it's leaving the rest of the consequences for the rest of the world. Now, ultimately, as disruptive as all of this is for the world's financial system, I think it's more disruptive than people are giving it credit for. Right now, it seems kind of like a neat story, but you're talking about people who have trillions of dollars in dollar-denominated assets suddenly asking themselves, are these things going to be worth anything in a few years? That's going to cause some major changes in capital flows, and you can insert your metaphor about how it's going to end. But I am bullish, and today I'm actually fairly optimistic because, as I said to the guy on television, this current monetary era is the exception. The system that we're living under isn't the one that we have to live under for the rest of our lives. In fact, it might be that the one that replaces it is much more amenable to personal freedom, to liberty, to sound money, to sound government policies than the one we're living in. Because if the one we're living in has given us this result, it's probably better that we try something different. So what is that something different? Well, just to show you what the financial markets have said in terms of calling the Fed's bluff, I did these charts last night, and I think most of them have gone up since I did it. But I wanted to look at base metals, precious metals, and gold and silver separately. And all I wanted to show you here, there are two things. I don't know if this has a little... Do I press the button? Oh, look, there it is. Okay, so this is industrial metals. Interestingly enough, my view on industrial metals is that there's no recovery in the United States. China's taking it along, but the stock market's pricing everything in as if it were normal and that we're back to pre-Lehman Brothers collapse conditions. And one indication of that is the behavior of the industrial metals, which are more correlated toward GDP growth than the precious metals. You can see here, that's the 2008 highs. They haven't made those new highs, but they seem to be breaking out. This is the Goldman Sachs Industrial Metal Index. The only reason I show it, too, is you can look up here. I'm not a trader very much, but I do look at momentum and things like that. And this is one of my favorite indicators, the relative strength indicator. Anytime it gets sort of above 70, something looks overbought. And anytime it gets below 30, it looks oversold. And it's pretty useful if you're looking for turning points in where the market's going. But anyway, they're moving up. Those are the industrial metals. The precious metals, you can see, have been telling the world for really since March of 2009 that the Fed has completely lost it. It's lost control of what's going on. So they're already well above their 2008 highs. Silver is at a 30-year high. I know you probably just heard a lot about silver and gold, so I won't go into that. Interestingly enough, though, if you look again at the relative strength, it was according to this figure, you would have suggested that gold was way overbought about 3 weeks ago, and then it did fall by about $50. But then we had this QE announcement, QE2 announcement, and I think after a couple of days, whether it was institutional investors or retail investors or Bill Gross, some of these large institutional fund managers said, this is not good. For one, it's not good for fixed income investors, but generally it's just not good. So the fact that gold so quickly, or the precious metals themselves, so quickly reversed after being, I think, overbought, shows you that we've kind of gone into a new dynamic in the market where everyone expects the dollar index to rally and gold to sell off, and we look for the next spot to buy in. I think it could be a little bit more volatile than that. This one's interesting, and I just chucked it in there because I think there's a political aspect to this. This is the commodity index. And if you'll recall, in 2008, you started to see in the newspapers and on television these stories of food riots in the developing world. Rice prices in Asia, and wheat prices because of drought in Russia, and corn prices and soy prices, and on and on and on. And what this tells me, and there might be other people who have better analysis of this, but this is pure and simple inflation leaking into the real world. When you see it in industrial metals and precious metals, it's a commentary on people's perception of the Fed's policy. But this kind of inflation has real-world consequences. And I think that's what we're going to see more of, food and fuel. This is probably the one thing that could check the Fed's policy, is other nations are going to say, this is unacceptable for us. It's causing political instability when you see soaring food prices. And obviously in the developed world, or in the developing world, those expenses are non-discretionary. People spend most of their money on food and fuel. So keep your eye on these, and as they reach new highs, which they may soon, I would expect there to be a lot more headlines about the disasters of coupling your currency to the dollar. And what that's going to do is it's going to accelerate people having to deal with this issue of dollar devaluation and removing it as the reserve currency. They're going to have to deal with it, or they're going to have to deal with this. And dealing with this means dealing with upset people in the streets who can't buy bread. Just from a technical perspective, after that little wind-up, this is a pretty dramatic increase in the index. So it also could be that there's a fair bit of speculation here. But everything the commodity markets are telling you is to distrust what the Fed is doing. And obviously, here's our old yellow friend. This was before the move overnight in the markets. And you can see there was the big correction when it looked oversold, and it remained in this oversold territory. If you use RSI, it remained there for a while, but it's quickly rebounded, and now we'll see where we go from here. So that's kind of where we are financially. But where are we philosophically? Where are we in our attitudes towards the most important issue, in my view, behind the price of gold? Where are we in our attitude towards debt? And I think these next two slides, this is always interesting, I think, when you're trying to represent an idea with an image and you go into Google, and if you've ever done this, it's kind of fun. So go into Google and pick something. So what I picked here is I picked the word retirement. I said, I want to see what images Google suggests of retirement. And it suggested this one. And the reason I put it up is I want to talk about the two things I mentioned at the beginning, the welfare state and the warfare state, and where we are in our attitudes towards them, because I think that has a lot to do with where gold goes. Our attitude with the welfare state now has evolved. Now, I'm not a big student of it, and I think you probably heard a little bit about it before. But from my understanding, as a sort of amateur historian / literature major, is it evolved from Bismarck in Prussia in the 19th century. And it was a way of promising social benefits to people to sort of co-opt them politically to support the regime. That doesn't sound that unusual. That happens here in Australia. It happened a couple of years ago. But what's happened really since then, and since the previous speaker mentioned the financial system used by the Dutch and the English to defeat the French in Louis XVI, is they used debt to do it. They used debt and they financed that debt by levying taxes, which made debt perpetual. You could always pay the interest on it. So perpetual debt by the state became the linchpin for the success of our financial system. It was able to finance military conquest and finance trade and all the great trade companies that the Dutch and the British used to really open up the world. But what it's evolved into today is something very different, in my opinion. What it's evolved into today is this expectation that at some level the state's going to be able to provide for you for the last fifth of your adult life and take care of all your material concerns. And really it's actually gone beyond that. It's not just old age pensions and medical care. Even in our, for people who aren't at retirement age yet, the state is so intimately involved in all of our decisions about our schools, how fast we can drive, how much is too much to drink, what food we should eat, when we should smoke, what our advertising should say, what's appropriate to watch on television, what's not appropriate to watch on television. I think that this massive level of intrusion, which we've somehow just kind of taken for granted now, because we're used to it, all of it owes itself in some way to this power of the state to perpetually increase debt. We've placed more and more responsibilities on it, and we've ceded more and more of control in our own lives, including financial control. Even if you don't want to get into the political aspect of the discussion, the percentage of financial activity that the state is involved in is as large as it's ever been. So I think that's part of the discussion we have to have, because if the gold standard reasserts itself on state finances, then the number of things the state can do in your life is going to recede dramatically. In my view, that's positive as a libertarian. Now, it will have real consequences, because there are people who are subsistent on state benefits. So it's going to be incredibly socially disruptive. But that's why I think this is a somber discussion. We're not really talking only about asset classes and what's going up and what's going down. We're talking about a fundamental reorientation of how the government can pay for itself, that it's going to have to finally start living within its means. And this dream is probably just a pipe dream and is not going to happen for most people. Not here, not China, not India, not the United States. The other aspect is that if we had it coming, if we promised ourselves all these benefits from the state because we could, because our economies were growing and we benefited from the outcomes of the wars, other people didn't deserve it because they had it coming. So we owed it to ourselves, and they had it coming. And what I mean by this is, and this is as far as I'm going to get into this discussion, but what I want to suggest to you is that there is an inherent connection between no gold standard and a fiat money system and the level of warfare in the world. And this is historically borne out. So the golden age of free trade in the world in the 19th century, there was a gold standard. There was a penalty for deficit spending. States were held accountable for what they did, and the world did not explode into war as it did in 1914. So this is either coincidence or there's an inherent correlation. Governments who are able to print money indiscriminately end up abusing that privilege. And usually what they do is they blame somebody else eventually when it goes bad, and they go to war. So there's a discussion here about whether something like this could happen in the United States. But this is what I mean when I'm talking about the welfare state on one hand, the promises we've made to ourselves, and the warfare state on the other hand, the accusations we've leveled at other people. The state has used the fiat money privilege to generate both of these things, and I think that's what's changing. And I think that's good, but I think it's a very disruptive change. And when I had to summarize it, I just summarized it this way. Fiat money permits the permanent expansion of the state in foreign and domestic affairs. A gold standard does not. This is why so many people don't like gold, even if they don't really understand it. Now, I don't subscribe to any of the elaborate theories that there's of the Illuminati or there's a banking cartel. I think these things evolve because it benefits certain people and they like the system that they've got. But for most of us, the system we've got isn't tenable. So this quote I wanted to focus on at the end, this is a David Ricardo quote, and he basically points out what I've just said, that if you cede the right to change the money supply to the government, you're going to get some unwelcome outcomes. But the one that he's talking about here, the people that we need to talk about are the issuers. These are the people that are still in charge of the global economy. So what are they doing? And where are they taking us? Well, my view is they're taking us straight to equalization of incomes with the developing world. And a few years ago, I developed this idea of explaining it when I had taken a tour of the world. It took about 6 months, and it was a very superficial tour. So it wasn't like Marco Polo. But I went to China and Japan and India, stopped here in Australia, and I was living in Europe at the time. When I came back, I said, look, this is what I think is going on. There's a giant migration of capital in the world, of capital and labor. These welfare states in Europe, in the United States, and to some extent Japan, have made promises that they're not going to be able to keep for demographic reasons. That reality has just been accelerated by their assumption of all these liabilities of the banking sector. But the fundamental problem was there anyway. The social arrangement that the welfare state promised wasn't affordable. And it was creating these massive capital transfers and capital flows and opportunities, especially here in Australia. This has been great for the commodities sector, so it's not all bad news. But the most important one was that the dollar standard is ending. So that's just accelerated since then. And more importantly, I think in context of what I said at the beginning, this super cycle, this experiment in money that's not backed by real things, money that's not backed by precious metals, that's ending too. And if that super cycle, I'd say, is a 300-year super cycle, and it's started to increase in intensity in this century, But I think that's what's ending. So if that's ending, it's going to have some serious consequences. And really, in 2008, all this started to happen, and the Fed printed money, the ECB printed money. Everybody said, look, let's just give it time. And that didn't turn out to be a very good strategy. Hope has not improved the quality of the assets in the European banking sector, which is mostly sovereign debt, or the quality of the assets in the American banking sector, which are mostly housing assets. So the Fed has been trying to drip feed earnings into the banks and give them time to rehabilitate, give them more debt, and hope that they can, grow out of it. But that doesn't respond to the fundamental issue. The fundamental issue is people took on way too much debt. So now we have this proposition, and it is a proposition because we're not really sure how it's going to work yet, that gold is being reintegrated into the world's monetary system. And I say reintegrated and not remonetized because we don't really know how it's going to be remonetized yet. Now, someone may have mentioned this before, but I thought I'd put the quote up anyway because it caused quite a big stir. Robert Zoellick, the president of the World Bank, wrote an op-ed in the Financial Times. Now, keep in mind, this is ahead of the G20 meeting in South Korea later this week. So there's a lot of angry people right now who've been devaluing their currencies competitively to try to retain their advantage. Now we're going to put them all in the same room. And, I'd like to hear what they're going to say.
Can we give them guns?
That would probably be the best outcome for all of us, I think. Although I'm nonviolent, so I shouldn't say that. But what's going to happen? Well, Zoellick probably didn't seriously entertain the possibility that gold is going to be remonetized. And he really didn't say that. If you read his quote, he said, look, we've got this basket of currencies, which actually is what resembles the IMF currency, the SDR, the special drawing rights. It's a currency the IMF created back in the 60s. And I think that's going to come back into our discussion later. But the important word that he used, which was vague, is this. The system should also consider employing gold as an international reference point of market expectations about inflation. Well, you've seen what gold did overnight. We've seen what gold's done in the last year. I don't know if you want to reference gold or if you want to ask it its opinion. But it's already said what it thinks about this. It's said that the dollar devaluation is inflationary, and as long as everyone else follows that policy, it's going to be inflationary. So that's the point that they've reached. I don't know where they're going to come out of this meeting this weekend, but that's part of the question. I'll betray part of my answer. Is at least $5,000 is where gold is going to go. I don't know how soon or how many corrections there will be, but these are the last three things I want to talk about today in some detail. So we'll go through them, but I'll just give you a preview of what I want to talk about. One is, what is the current state of the financial system and why is that bullish for gold? Two, the other parity, 55 equals 55, and I'll explain what that means and why that's particularly bullish for Australia. And three, what do we really mean when we talk about a world financial order that's based on sound money? What would that world look like? Is it realistic? Will it happen in our lifetimes? Is it organic? Is it designed? I'm going to just give you a few ideas on that. But first of all, this was something that the Wall Street Journal published the other day that I guess the point I wanted to make, last year at this conference, there were a lot fewer people in the room, but we said 2010 was the year the global financial crisis became a sovereign debt crisis. And of course, it happened. You saw problems in Ireland, problems in Greece, problems everywhere, really. But because it became a sovereign debt crisis and not a private sector financial crisis, the government was able to sort of kick the can down the road. So in Europe, they've taken various austerity measures to try and deal with the problem and reassure capital markets. And of course, the Fed has taken the other route. It said, look, we're just going to print our way out of it, and then we'll pay back the money later, maybe. But what's really, this was a stunning chart because it shows, I'll show you why. Actually, I think it's stunning on its own. But $10.2 trillion is the amount of capital next year required by just selected governments to borrow, to roll over existing debt. And this doesn't include any new bailouts or any new requirements that might result from a bank failure or a sovereign failure in Ireland, for example. So just a few highlights on this to show you what jumped out at me. One is that Japan owes a lot of money, and the people that have been financing its deficits have been its own people. So it hasn't had to repay anybody. Its savers have been happy to buy government bonds because they're kind of demographically downsizing as well. But the size of the Japanese deficits are getting large, probably maybe too large to be financed exclusively by internal saving. And if that's the case, then you might expect to see higher interest rates there, and maybe